It's really funny how we interact with the physical world. Like if you're walking through a grocery store, you might just grab a cold drink out of the fridge, pop the tab on that aluminum can, and, hear that extremely satisfying
Oh,
sound.
yeah, the classic pop and hiss.
Right. It's immediate, it's refreshing, and honestly, it's entirely thoughtless. You just drink it, toss the can in the recycling bin, and move on with your day.
Well, because the product you actually care about is the beverage, right?
Mm,
I mean, the can itself is just the delivery mechanism, so it basically remains invisible to us.
completely invisible. But if you take a magnifying glass to that exact same aluminum can, suddenly you aren't looking at a simple metal container anymore. You're looking at a master class in global economics.
Yeah, and supply chain resilience.
Exactly. And some highly orchestrated Wall Street financial engineering. So, welcome back to another deep dive. If you're wondering why we're dedicating time today to unpack a stack of sources about a packaging company's earnings, it's because understanding the hidden global machinery behind that everyday object is, well, it's one of the most fascinating business stories of the year.
And I got to say, the source material we have to get through today is dense, but it is incredibly revealing.
It really is, although gathering this material was a bit of an adventure for me.
Oh, really?
Yeah. Before we could even get our hands on the financial data for this deep dive, I had to pass a literal security verification test.
Ah, right, the infamous bot check.
The bot check. Shouts out to MarketBeat and Cloudflare for making me prove my humanity. I was literally staring at a page that just said, "Please wait while the website verifies you are not a bot." And it gave me a Ray ID.
Array ID.
Yeah, Ray ID 9F7068395C81E26. Just in case anyone was wondering, I am in fact a human, and I am highly motivated to talk about beverage packaging today.
I mean, the heavy security makes a lot of sense when you consider the sheer scale of the financial data we're looking at here. We're dissecting Ball Corporation's first quarter 2026 earnings release, which is dated May 5th, 2026.
Right, because Ball Corporation is not just a company that makes cans. It is a $19 billion asset behemoth. Understanding their first quarter of 2026 is basically a crash course in how global businesses use, pricing power, geographic shuffling, and corporate pruning just to stay highly profitable in an incredibly volatile world.
It really serves as a perfect case study because on the surface, you'd think a manufacturing company's success relies on a simple equation, right? You make more physical things, you sell more physical things, and your profits go up.
Makes sense intuitively.
Right. But when you reach the scale of a Ball Corporation, that traditional volume-based equation gets completely flipped on its head.
Okay, let's unpack this because we should start with the top line numbers for Q1 2026 since they look pretty staggering at first glance.
They really do.
Yeah, Ball had a stellar quarter. Their U.S. GAAP total diluted earnings per share hit 77 cents, and that is up from 63 cents in the first quarter of 2025.
A very healthy jump. But it's worth pausing on that GAAP metric for a second. GAAP stands for Generally Accepted Accounting Principles. It's basically the raw, unfiltered look at a company's financials, which includes every messy, one-time event that happened in that 3-month window.
Right, like if they sold an old warehouse or, I don't know, paid out a massive legal settlement.
Exactly. GAAP forces them to include that in the final number, even if it has literally nothing to do with their core business of making cans.
Which is why analysts usually want a cleaner look at how the actual factory operations are running.
You're hitting on something crucial there, yes.
Right, which is why Ball also reports their comparable diluted EPS, which basically strips out all that one-time accounting noise.
Yeah.
And when you look at that clean number, it was 94 cents. That is a massive 22.1% increase from 2025.
22% is huge.
It is. Their comparable operating earnings reached $387 million, which is a 9.9% increase on net sales of $3.60 billion for the quarter. So looking at those numbers, my immediate thought is, wow, people around the world must be drinking way more canned beverages than ever before.
And that is the exact trap a lot of analysts fall into, because the baseline assumption is that 22% more profit obviously means 22% more cans rolling off the assembly line.
But then you scroll further down the report and find the catch. Global aluminum packaging shipments, meaning the actual physical volume of cans leaving their factories worldwide, only increased by 0.8% in the first quarter.
Less than 1%.
Less than 1%. It is like a local coffee shop selling the exact same number of lattes as last year, but somehow reporting a 22% increase in their profit margins. So how does a company actually pull that off? Are they just squeezing the consumer, or is there some sort of financial magic happening here?
What's fascinating here is how the mechanics of industrial pricing actually function on a global scale. It goes far beyond a coffee shop just arbitrarily raising prices.
Okay.
To understand that 22% profit jump on less than 1% volume growth, we have to look at what Ball's chief financial officer, Dan Rabbitt, refers to in the report as pass-through mechanisms.
Pass-through mechanisms. I mean, that just sounds like corporate jargon for automatically passing the buck to the customer.
Well, functionally it is, but structurally it's a survival mechanism. Consider Ball's position in the supply chain here. They don't mine bauxite out of the earth. They don't smelt raw aluminum themselves.
Right.
They buy raw aluminum off the global market, shape it into highly specialized packaging, and then sell it to beverage companies. Aluminum trades on exchanges, like the London Metal Exchange, and its price fluctuates wildly based on variables Ball literally cannot control.
And what kind of variables?
Oh, things like European energy costs, geopolitical tensions, shipping disruptions,
Yeah.
you name it.
I see. So if the price of raw aluminum suddenly spikes by 30% and Ball is locked into, say, fixed price contracts to supply cans to a major soda brand for the next 5 years.
That spike could completely wipe out Ball's profit margins overnight. They would be operating at a massive loss within weeks.
Wow.
So to prevent that catastrophic risk, Ball negotiates these pass-through mechanisms into their B2B contracts. It's essentially a legally binding inflation rider.
Okay, so if the cost of raw aluminum goes up on the global market, Ball doesn't eat that cost. They take that exact increase and pass it directly through to their customers, the beverage brands.
Exactly. So when aluminum prices are high, Ball's total sales figures just automatically inflate. Their reported revenue goes up strictly because the raw material they're passing along is more expensive, not because they're inherently doing more work or shipping more physical pallets of cans.
That is wild. That completely insulates them from commodity risk.
It does. But it also means that top-line revenue growth isn't really a reliable indicator of their actual operational success. The real story, as their CEO Ron Lewis points out, relies on their streamlined operating model.
Because their profit margins on the actual manufacturing are shielded, right? So any tiny improvement they make inside their own four walls, whether that's making an assembly line 5% faster or reducing their corporate headcount,
Or restructuring their debt,
that drops straight to the bottom line.
You got it. They don't need to sell dramatically more cans to grow earnings by 20%. They just need to operate their existing factories tighter and let those pass-through contracts shield them from the chaos of the commodities market.
But a toll booth only works if cars are actually driving through it, right?
Yeah.
Even with ironclad contracts, you still need consumer demand to keep those factories humming. And that tiny 0.8% global volume growth hides some pretty dramatic shifts when you break it down geographically.
Oh, absolutely.
To really understand where that growth is and isn't happening, we have to look at how Ball has restructured their physical footprint around the world.
Right. And in this Q1 report, they made a significant structural change to how they categorize their segments for Wall Street.
Yeah, they took what used to be a generic beverage packaging other category and folded those specific plants into their EMEA segment, which stands for Europe, Middle East, and Africa. And EMEA is carrying a lot of the weight right now.
It definitely is.
Sales hit $1.11 billion with earnings of $134 million. Volume grew in the low single digits. But a major driver of that story is a brand new, highly strategic acquisition from January 2026.
The Benepack acquisition.
Yes. They bought an 80% stake in two major facilities in Belgium and Hungary from a company called ORG Technology. They also reclassified facilities in India, Myanmar, and Saudi Arabia into this newly expanded segment.
That's a huge shift in their map.
Exactly. Meanwhile, their North and Central America division is just acting like a steady, reliable engine room. They reported $205 million in earnings on $1.78 billion in sales. That was also driven by higher aluminum prices activating those pass-through contracts alongside low single-digit volume growth.
So North America is steady, and the newly expanded EMEA segment is growing. But a global strategy means you are exposed everywhere. And looking at their numbers, one specific region is really pulling that global average down.
Right. Here's where it gets really interesting, because the data for South America looks incredibly vulnerable. Earnings were completely flat year over year at $67 million on $585 million in sales.
Flat earnings, yeah.
But the volume, the actual number of physical cans purchased by beverage brands in that region decreased by mid-single digits. If volume in South America is dropping that significantly and earnings only look flat because they're charging higher prices for aluminum, isn't that a ticking time bomb?
It's definitely a risk.
Right. What happens if local South American competitors who maybe don't have Ball's massive global overhead start undercutting them on price while the volume just continues to bleed out?
Well, if we connect this to the bigger picture, you are highlighting exactly why multinational operations require a massive balancing act. Relying on pass-through price hikes to mask falling physical volume is dangerous in any single region.
Obviously.
South America is currently navigating a very complex macroeconomic environment. Inflation is heavily impacting consumer purchasing power down there. And when wallets tighten, consumers might shift away from premium canned beverages to, say, cheaper alternatives or larger plastic formats. Ball is well aware of this shifting consumer behavior.
So they have to offset the drag from South America somewhere else. It's like a massive ship using a ballast system. If the boat is taking on water and leaning heavily in South America, they have to pump resources and capture weight on the opposite side of the ship to keep the entire enterprise upright.
That is an excellent way to visualize it. And that brings us right back to Europe and the Benepack acquisition. While South America is dealing with macroeconomic headwinds, Europe is experiencing a massive legislative and cultural push towards sustainable packaging.
Oh, right. Single-use plastics are being aggressively phased out by regulators over there.
Exactly. And aluminum, which is infinitely recyclable, is stepping in to fill the void.
So by acquiring those facilities in Belgium and Hungary, Ball is basically instantly dropping a bucket into a market where demand is surging.
They are using geographic diversification as their ballast. The growth in EVA, driven by European sustainability laws, combined with the rock-solid stability in North America, buys them the financial cover they need to weather the economic storm in South America. The overall corporate earnings look phenomenal, even if one specific region is struggling.
Man, it really changes how you view a simple soda can. The fact that a manufacturing plant in Hungary is essentially serving as a financial counterweight to consumer inflation in Brazil is just wild to me.
It's the beauty of a global supply chain.
But pumping that kind of ballast into Europe isn't cheap. Buying an 80% stake in two major European manufacturing plants requires serious capital. You don't just finance that kind of expansion out of petty cash.
No, you absolutely don't. And this introduces perhaps the most aggressive component of CEO Ron Lewis's strategy for 2026. To fund these massive strategic acquisitions while simultaneously delivering immense returns to Wall Street, Ball is systematically shedding anything that doesn't fit their core mission.
Right, they are ruthlessly trimming the fat. If you look at their recent history, they're actively deconsolidating peripheral businesses. Like back in March 2025, they partnered with an investment firm called Aina.ai to offload their aluminum cups business.
Yep.
Then in August 2025, they sold 41% of their Saudi Arabian business, just stepping back and keeping only a 10% minority stake for themselves.
And to understand why a company would actively shrink its footprint in certain areas, you have to look at the intense financial targets leadership is committed to.
And those targets are incredibly ambitious. CEO Ron Lewis has publicly committed to a 10+% annual EPS growth and generating greater than $900 million in free cash flow in 2026.
It's a huge target.
And the ultimate destination for a lot of that money. They're on track to return at least $800 million to shareholders through buybacks and dividends by the end of the year.
Right. Returning $800 million to shareholders in a single year is a massive extraction of wealth from a manufacturing business.
So what does this all mean? To me, it feels like they're aggressively pruning a giant oak tree. They had this massive global enterprise, and they're intentionally cutting off the interesting experimental branches, like the aluminum cups business.
Yeah.
They are giving up majority control of emerging market segments like Saudi Arabia. And they're doing all of this so that the main trunk of the tree, the core high-volume beverage manufacturing can grow as thick and profitable as humanly possible. But by focusing entirely on share buybacks and dividends, aren't they sort of sacrificing long-term innovation for short-term Wall Street applause?
This raises an important question, and it points directly to a metric Ball specifically highlights in this earnings report, EVA, or economic value added. The report actually states they are focused on advancing sustainable aluminum packaging while increasing EVA.
Yeah, I saw that acronym used repeatedly. I know it's a measure of financial performance, but what does increasing EVA actually look like on the factory floor? Does it just mean cutting costs?
It's actually a lot more sophisticated than just cost cutting. EVA is a metric that judges residual wealth. It basically forces management to ask a very strict, unemotional question. Is this specific project or this specific factory generating enough profit to justify the cost of the capital tied up in it?
Wait, clarify cost of capital for me in this context.
Think of it this way. Money isn't free.
Mm.
If Ball has $100 million, they could invest it in their core can business, they could invest it in an experimental aluminum cup business, or they could just put it in a treasury bond and earn a guaranteed yield.
Okay, sure.
If the experimental cups business requires $100 million in capital to scale, but it only generates a 3% return, while the core beverage can business generates a 15% return, then keeping the cups business actually destroys economic value.
Oh, I get it. Even if the cups business is technically profitable on paper, it's a failure because that money could be working much harder somewhere else.
Exactly. It becomes a drag on the overall efficiency of the enterprise. Wall Street doesn't just want growth, they demand disciplined growth. So by partnering with Ina.ai and abandoning direct ownership of the Cups project, Ball is proving to the market that their financial discipline is absolute. They just won't get distracted by shiny objects.
And that extreme discipline is what allows them to weather financial hits that would, frankly, terrify a lesser company. For instance, in this very quarter, Q1 2026, Ball reported a $1,042 million hit to their adjusted free cash flow.
Yeah, a massive number.
Over $1 billion in negative cash flow. Usually when you see a billion-dollar hole in a quarter, it means the company is bleeding to death. Why didn't Wall Street completely panic?
Because you have to separate operating cash flow from strategic capital deployment. That billion-dollar negative figure wasn't because they couldn't sell cans. It was driven by a combination of heavy capital expenditures, like the massive European investments we just discussed, and a significant cash tax payment related to a previous disposition.
So they were basically just paying their tax bill and buying a new house? The core business of making cans was still generating cash.
Precisely. For most companies, a billion-dollar cash outflow in a single quarter would cause a major liquidity crisis. But because Ball has so aggressively pruned their non-core assets, and because their pass-through pricing protects their daily operating margins, they can easily absorb that massive strategic hit.
They just brush it off.
Yeah. They can take that billion-dollar outflow in Q1, still confidently project $900 million positive free cash flow for the entire year, and guarantee that $800 million shareholder payout. The market sees that predictability, and they reward it.
It's an incredibly tight ship. They're optimizing every single operational variable they can control, and they're building contractual moats around the commodity variables they can't. It really has been a journey going through this data today.
It really has.
We started by passing a literal bot check just to access the numbers, and we've ended up decoding how this incredibly common everyday item, an aluminum, can actually represent a $3.6 billion quarter.
It's all hidden in plain sight.
It is. It's a business built on pass-through pricing that makes them practically immune to raw material inflation. It relies on strategic European acquisitions acting as a ballast against South American economic turbulence, and it's driven by a brutal, calculating approach to pruning any project that doesn't maximize economic value added. I know the next time I pop open a cold beverage, I'm going to be acutely aware that I am holding the end result of a highly calculated global supply chain.
It is hard not to look at the physical world differently once you understand the economic machinery operating just beneath the surface. But I think there is a lingering tension hidden in the mechanics of this business model that is worth leaving you, the listener, to mull over.
Oh, what's the tension?
It goes back to the pass-through pricing. We talked about how brilliant it is that Ball passes the fluctuating cost of raw aluminum directly to the beverage brands, right? Shielding their own profits. And of course, those major beverage brands don't want to absorb that cost either, so they ultimately pass that inflation down the line to the grocery store.
Which means it eventually lands right on the price tag for the consumer.
Exactly. Ball's entire financial moat is built on the assumption that they can always pass the buck. But if inflation continues and the cost of raw materials keeps pushing the retail price of a six-pack higher and higher, eventually you hit a breaking point.
A point where the consumer simply refuses to pay the toll.
Right. At what point does a standard canned beverage become too expensive for the average consumer to justify buying? Ball Corporation has built an incredibly resilient, nearly immune business model for themselves, but it relies entirely on the end consumer continuing to absorb the final cost. Plus, if a company is so relentlessly focused on maximizing quarterly shareholder returns that they outsource their innovative side projects, who is actually going to invent the next major leap in sustainable packaging? Will true environmental innovation come from the $19 billion giants? Or will it require a company willing to sacrifice a few quarters of dividends to actually change the world?
Wow, it makes you wonder how elastic our everyday habits really are. Next time you grab a cold drink, take a second before you pop the tab. You aren't just holding a beverage, you're holding a tiny piece of the global economy and deciding whether or not you're willing to pay the final toll.